Hey everyone, it's Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about 1% increases and qualifications. What does it mean for you and your mortgage? Not just higher payments, but tougher qualifications. Stay tuned. We're going to get into that next. Now that the Bank of Canada has increased its policy rate 1 full percent, there are going to be some major changes to clients' finances and even their ability to qualify if they're looking to go buy, refinance, or even renew their mortgage in the next few months. Now, before we get into those, please don't forget to hit the like, share, and subscribe button. Hit that notification bell so you can get notified every single time we post a brand new video. Now, last week, I spoke to a client which we had pre-approved back in March, and we had given them a great rate secured at 4.09% for 120 days. Now, obviously, that client had not been able to close on their mortgage because they were unable to sell their home. And in order for them to close on their home, they did require that firm sale. In order to get that, they need a bridge loan, firm purchase, firm sale. Now, luckily, the clients were able to get an extension for about 3 weeks in order for them to basically arrange other financial options, which we had talked to them about even at the beginning, about private equity, lending, and other options, obviously co-signers coming up with more down payment, repositioning that other property, but the clients did not want to do that. Now, against my advice, as well as the realtor's advice to sell their home first, the clients went out there and purchased. So obviously that put them into a situation where now they are basically within a couple of days of their existing rate approval of 4.90% expiring. When I reached out to the clients prior to July 13th, because of the fact that we knew that the Bank of Canada policy rate was going to go up at least 75, obviously it shocked everybody with a 1% increase. I basically advised the client, say, look, if we have to push out 3 weeks or 4 weeks and you're able to get that because the sellers were graceful enough to allow them to do that, which was really, really nice of them, because obviously they didn't need those funds to close. So they were able to get a 3-week extension. I said to them, before we increase that, in the event that you're not able to close in that window, because of the fact that you're not going to get the 4.09, let's try to get you approved at least on a variable, because obviously fixed rates right now are elevated at over 5% in your particular scenario with 20% or more down, and you need a 30-year amortization. You can't go insured and you can't go with 25-year. You need a 30-year. So the client said, okay, let's redo it. So luckily we were able to reapprove them, get them in on that product to secure them at prime when it was still at 3.70% and their previous discount on that mortgage. And we'll get into that in just a moment. But as you can see, this particular client was actually lucky enough that we were able to do that with them. And that's why we always say who you work with does matter, and understanding your exit strategies and your options is always going to be important, because if that client would have waited till after July 13th and the banks had changed their prime rate, that client would have not qualified for that mortgage. And we'll get into that right now. So what I want to just draw your attention. So obviously this product here for this client, we've used very similar scenarios for this particular client. Max purchase price with 20% down. Their income combined was around $120,000, and we did a 30-year amortization, keeping the ratios very in line with the lender's requirements. Now, obviously, there was room for some negotiation on those ratios because they are putting 20% down. But remember, these products are generally the most riskiest to the lenders, anywhere from 20 to 35%. So obviously, we were able to get the client in at 3.70% minus 55, which means they still qualified at 5.25%. And we were able to get them at least the $820,000 mortgage at this payment as of today. Obviously, as of July 13th, that payment will definitely be changing because of the fact that prime and the rate would have gone up on their mortgage. But the major important part for this client was that we got them approved at 5.25%. Because as you'll see here, if we would have basically gone and got this client approved at the prime rate as of today at 4.0%, and we would have waited, they would have lost 10 basis points on their actual mortgage. They would have had to qualify at 6.25% here. Now, obviously, that means they would have only qualified for $740,000, as opposed to if they would have gone fixed, they would have only qualified for $650,000. They would need to qualify for the full amount of $820,000 because otherwise they had no more money to put down. And that's a huge jump. That's literally $80,000 that the clients did not have. especially because they would have had to put together money for closing costs, land transfer tax, and so on and so forth. And what I've also done here is, just for curiosity, just to draw a parallel here, you will see that we've even done it for an insured mortgage. Let's say the same parameters with only 10% down. Let's say the clients were not able to put down the 20%. They would have only qualified for a $600,000 mortgage and only a $540,000 mortgage if they would have got it with 25-year amortization and insured with less money down. Obviously, the clients did not have a choice in this matter. They needed to sell their home or qualify prior to the change. One important thing you'll notice here is that obviously the amounts of those mortgages are just below the $3,000 mark. But the most important part is that that client, although they know that on the variable rate mortgage, their payments will change if September 7th we see a further increase, that is understandable. But the client did not have the funds in order to basically meet that shortfall now that they've had to reduce the price on their home to ensure that they sell it. So obviously many Canadians moving forward may find themselves in a situation like this, whether it be that they've purchased a home, maybe they're looking to refinance their home, and under the higher qualifications, they may find that they don't qualify for as much as they previously did just a few months ago. And we also did a video on this, so feel free to go back and check that out. But basically, we did look at all those options, and luckily we were able to provide that client with the solution to pre-approve them for the amount before the rates went up in order for that bank to honor that 525 qualification for the next 120 days. Who you work with does matter, and obviously, you know, understanding their situation, we were able to help that client make sure that they can get through the door. Now it's up to the client to make sure that they sell that home and keep themselves at least at an $820,000 mortgage to make sure that they sell and at least have that 20% to put down on that next house. Clients did have more than 20% to put down originally, but as the prices had dropped, so did the client's ability to come up with that down payment. So if you find yourself in this situation or know someone who might be in a similar situation, or you're looking to go out there and purchase a home or even refinance your existing mortgage, understand that these rates obviously will have an impact on future borrowing power. We'll leave the video here. We hope everyone has a great Friday. Once again, thank you for clicking in on our videos. We appreciate everyone's comments. Don't forget to leave those below. Let us know what you think is going to happen on September 7th. But until next week, have a great Friday and an even better weekend ahead. Thanks for tuning in.